Hey, welcome to Chapter 5. We're going to be talking about accounting for merchandising operations. Chapters 2 through 4 focus primarily on our service companies, and so we focused a lot on the revenues and expenses that way. But when we get into accounting for merchandising, we're going to add a few little additions in how we calculate net income, for example, and how we treat inventory. So let's go ahead and have a look. If my computer doesn't get rid of that spinning wheel of death. All right, here are your learning objectives. Okay. All right, describe merchandising activities and cost flows, what we're going to do first. So when we're dealing with our service companies like we did in chapters 2 through 4, our focus was creating revenues, subtracting out our expenses, and giving us our net income. But when like the slide says, we're selling time. We're selling our talents, basically. We have accounting firms, law firms, and to some degree plumbing services, because a lot of times plumbing services will also sell their products to help, hey, we'll install this for you with our stuff, and then you're buying their products. So, but a merchandiser does things a little differently. Because a merchandiser is selling inventory, we're going to have a calculation called cost of goods sold. Now, knowing us accountants that we don't come up with clever names, it legitimately is the cost to us of the goods that we sold. And we're gonna take that out of our net sales. Net sales is gonna be all of our gross sales and all subtracting out all of any of the adjustments we need to make for it, and we'll get to that in this chapter as well. So we'll have net sales minus cost of goods sold. That's going to equal our gross profit. Then anything else expense related, we'll subtract that to get us our net income. So pretty much bottom line is we're just adding these two steps in here with adjusting revenue. Instead of revenue, it's net sales. And there's two examples here. You have H&R Block and Nordstrom. H&R Block is a tax service company. You see that they only have revenues and expenses, and then you see Nordstrom has cost of goods sold and things like that. Here's the operating cycle for a merchandiser. It starts off with, you purchase things, inventory to sell. You sell it. Maybe it's credit sales or maybe it's cash sales. Either way, you get sales. If it says credit sale, you have accounts receivable. You collect the cash and you purchase it. You just do this over and over again. This is a graphic that you can use that is very efficient, very helpful. I find that a T account is also very helpful. And I'll probably show you that in one of the snippets. So make sure you watch some of the snippets as well if you're not doing that already. But the bottom line is merchandise available for sale is equal to both net purchases plus beginning inventory, and it also equals cost of goods sold plus ending inventory. The merchandise available for sale is basically what the amount of inventory you have to account for at the end of the accounting period, whether that's the cost of goods sold or whether you haven't sold it and it's ending inventory. As long as I can give you 3 examples or 3 of these items in here, and you should be able to calculate the other 2. And again, watch some of the snippets, maybe some of the homework help, and you'll see how that will impact that. We have 2 different types of inventory systems. One is the perpetual and the other is the periodic. Think of them like this. A perpetual inventory system is going to update things perpetually, constantly over time. Think of it as like when you go to Walmart and you scan your items in. It's not just telling you how much that product cost. It's also updating their inventory, saying, hey, we've sold this. We have this much left or should have this much left. It's possible, that you have other issues with that, theft, shrinkage, stuff like that. But that's the idea of a perpetual inventory system, is that it's constantly updating as transactions occur. Periodic system updates things periodically when it gets around to it, usually at the end of the month, quarter, year, things like that. It's not up to date always, and the information can get outdated pretty quick if you're not updating it soon enough. So that's the difference between these two. And as we do our inventory systems in chapter 6, you'll see the difference between how perpetual and periodic inventory systems work. So we're going to analyze and record transactions of merchandisers using, and we're going to focus on the perpetual system. But before we do that, let's focus on purchases without any cash discounts. A lot of times when a company has a items for sale, if you pay in cash, sometimes if you're a retailer and and someone else, the merchandiser will give you a discount if you're paying in cash, but not always. But the bottom line is that when you sell inventory, you're going to when you purchase inventory, you're going to buy that inventory for whatever it cost you. If it cost you $500, you can say $500 for inventory, $500 for cash, boom, you're done. Debit the inventory, credit the cash. But what happens if we have a discount? What happens if for example, we may have, let's say we're a company and we want to increase our sales. Well, not everybody wants to buy in cash. A lot of people say, hey, I want to be able to sell some of this before I have to pay you. So we'll give them credit terms. And a lot of times it's something that's called like 210 net 30 or 2/10 N/30. Okay. It's just a nomenclature that basically says, listen, if you pay this in a certain amount of period, we'll give you a discount. Otherwise, the full invoice is due by that end of the ending period of time. And it could be anything. I mean, you could have it whatever. Doesn't matter. But that's what this graphic here is showing us. The credit period is basically from the time of the purchase to when the invoice is due and needs to be paid in full. That's the credit period. The discount period is that first little window of time that says if you pay in this amount, or you pay the amount that you owe us in this period, you can take a certain amount of percent deduction on that transaction. So let's look at this. This is red 210 net 30. The 2 represents the discount period percent. So this person's getting 2% discount. And the number of days that the discount is available is 10 days. So they have 10 days to take that 2% discount. Otherwise, the net or all of it is due in 30 days. Okay, and that's the credit period is the 30 days. That's how you're going to see this. Again, this could be 3/15, NEOM. That's 3% discount. I paid in 15 days. Otherwise, the remaining amount's due at the end of the month. So you can have just about anything in here. For those of you who are unfamiliar, this is what an invoice could look like. You can pause the video and look at that invoice all day if you want. So when we sell something, let's say, remember that inventory we purchased for $500. We went and sold it, but we sold it on credit. Oh, I'm sorry. We're buying this. I apologize. I keep getting these. And you will too. So we got to pay attention. November 2nd, we purchased $500 of merchandise on credit this time, and we're given terms 210 net 30. So we're going to debit our merchandise inventory for $500, and we're going to credit our accounts payable. Now, one of the things that I need you to understand, and I need you to remember, this is a foot stomping moment. This is hey, pay attention, siren, something going on. You got to know this. We value our inventory at the lower of cost or market. In other words, we're going to value our inventory at whatever it cost us in real dollars or whatever it's worth if it's lower than what we paid for it. So, for example, if I still had the iPod 1, I don't know if they called them ones, but iPod 1, and I had 20 of them still, I don't think I can get someone to buy those from me unless it's a museum at the cost I paid for it. So I have to lower the value of those inventory to the actual value that they were. Now, we're not going to value our inventory higher than what we paid for it. Okay, it's the lower of either cost or market. So what happens if we take a discount when we have an inventory situation? So let's go ahead and find out. So we're given 210 net 30. What if we pay it in the discount period? What we're going to do is we're going to reduce our accounts payable because we owed them $500. We're going to reduce that by $500. We don't owe them anything when we pay them. But when we take that cash or that discount and we pay within that 10 days, that means we paid a total of $490 cash for this inventory, which means because of our prior journal entry here, our inventory was valued at $500, but we didn't even pay $500. We paid $490 because we took the discount. So we've got to reduce our inventory now to get it to the lower of cost or market. In this case, it's the lower, which is cost. Cost, which is lower. Sorry, switch those around. So we got to reduce our inventory value to match what cash we actually paid for this. So that's why we're going to credit our merchandise inventory and credit cash. Now, that's a concept that you may need to watch this video, this part of it, a couple times to fully grasp, okay? And that's fine if you have to do that. Here's the T accounts and what it looks like. First, when we bought it, we owed them $500, and then we debited $500 because we got inventory. Then when we paid them, we got rid of the amount we owed, zero balance. We paid them cash, credited that, and then we've got to reduce our inventory to match what we actually paid for it. That's why we do that. That's how that works. Because if we didn't take the discount, we would still have merchandise inventory at $500, but we would have a cash outlay on November 12th of $500. Basically, we'd have an accounts payable debit of $500 and a credit to cash for $500 if we didn't take the discount. Oh, there it is. If we did not take the discount, we paid after the discount period, that's what the journal entry would look like there. Now, in a lot of cases, places want to build a relationship with a customer like us. We're buying this product from another company so we can sell it. Well, what happens if something goes wrong with that purchase? What happens if something is wrong with the order? We order 20 purple bikes and we get 20 pink bikes. Well, there's a problem. It's not what we wanted. It's not what we ordered. So what we have are things called purchases, returns, and allowances. A purchase allowance is a reduction to the buyer of anything that's unacceptable or defective. So if I bought 20 purple bikes and they sent me 20 pink bikes, I'm going to call them up and say, you sent me the wrong merchandise. They said, hey, well, if you keep it, we'll give you a discount. Okay, all right, fine. I can try and sell these pink bikes. Purchase returns is something happened that made me want to return. Listen, these two bikes are broken. The hull, the frame is broken, and these are unacceptable. They're like, okay, well, return them to us so we can inspect them and everything, and we'll give you a credit for what you returned. That's what those two things do, okay? It's basically a reduction to the cost or total of the inventory that we have received, and so we have to reduce our inventory by these amounts accordingly. So let's look at an example. In this case, we called and said, hey, our bikes something was defective. And they're like, look, we don't care. Just throw them away. You know, give them to your employees or something, and we'll give you $30 allowance. In other words, we're going to reduce what you owe us by $30. And then if you've already paid for it, it's still going to reduce your merchandise inventory, but maybe you're going to credit like some kind of credit account to that company so that you can take that discount later on. Returns are a little different. Okay, we're going to return more of it, and we're going to send it back to them. So June 1st when we bought it, June 3rd is when we returned it, and then June 11th is when we paid for it. Now notice when we returned that $50 on June 3rd, we initially paid $250 for it. When we calculate our discount, we have to calculate the discount on what we actually are paying for, not what we've returned. Okay, so any returns and allowances, we only take that percent discount based on what we owe them. So in this case, we've dropped it down to $200. So we're only taking that 2% discount on $200, and which is $4. We're not taking it on the $250 because we've returned some of the merchandise. Again, if you have any questions on this stuff, please see me. Talk to me. We'll help you understand this. Okay. All right. There's other aspects that we have to factor into our inventory in the situation here, and that is transportation costs. Transportation costs are costs that a company will incur to get merchandise from one place to another. In this case, we have two: FOB shipping point, FOB destination. Now, I've heard several different, what does FOB stand for? Okay, freight on board, other things. I've only heard freight on board or something like that. And what it means is just whenever the freight freight on board at the shipping point or freight on board at the destination. It's when the transformation of the ownership of the goods occurs. So we're looking at FOB shipping point. The minute I put all of my stuff on the dock and it's ready to ship, I no longer, as the seller, own it. The buyer owns it, okay? And then if it's FOB destination, I own it through transportation until it gets to my customer. So we're going to send that, and we're going to own it during that time. Why is this important? Well, it's because from the perspective of the buyer, we got to know if we're putting this inventory in, or this merchandise into inventory. So let's pull in at FOB shipping point. If we're buying this stuff, we own it in transition. So which means we're paying for the shipping costs, and we have to include that shipping costs into our inventory, because the cost of inventory is going to be anything that gets that inventory to a sellable condition. And we'll learn about more of that in chapter 6. So we're going to include transportation costs. But if we're buying it and it's FOB destination, we're not paying for the transportation costs directly. We're probably paying it through a markup of our inventory. So either way, in theory, that transportation cost is going to be included in our cost of inventory. It's just that the seller is going to pay out of their pocket for the delivery of those goods. And they're going to do that as an expense. It's selling an administrative expense for them. And then they're going to pay that in cash either way. Here's an example. Here's an example of Z-Mart purchased merchandise on terms of FOB shipping point. Transportation charge is $75. So we're Z-Mart. We bought the stuff. It's FOB shipping point. It means we're going to pay for it in transition. And so we're going to own it at shipping point. So we're paying for it, the shipping charges, and we will put that to inventory. And don't get mixed up on the cash thing. It could be a debit to merchandise inventory and a credit to accounts payable. Okay. Or something like that. We could owe our UPS or whoever it is we're shipping it for us. Maybe like what we do is we just say, hey, just bill us at the end of the month for everything, and we'll pay it in one pop instead of having to pay every time if we do this a lot. That way, so we could be putting this to accounts payable -UPS or something like that too. So here's the itemized cost of purchases. So we bought all this purchase. We had some discounts and some allowances. We added the cost of transportation. So the total net cost of merchandise purchased right there is $232,400. That's what we're going to take the discount on if we have a discount at all. Okay, it's a good little slide for you to look at that. So now we're on the purchase side, but our goal as a retailer is to sell these items. So what do? How are we going to do that? Well, we're looking at net sales minus cost of goods sold equals gross profit, right? That's what we're going to look at here. So sale of merchandise, we have a revenue side and we have an inventory side, okay? Or a sales side and an inventory side. So this is how we're going to do this. Whenever we sell something, first we got to record how we're getting the money, and then we got to record the sale of the good itself. So here's an example. If we sold $1,000 of merchandise on credit, and the merchandise we sold cost $300, the revenue side is going to be a debit to our accounts receivable for $1,000 and a credit to sales for $1,000. Now, if we had sold this merchandise as a cash sale, all you can do is change the accounts receivable to cash. It's going to be the same thing. But on the cost, or it's going to be the same thing otherwise. Cost side journal entry, it's going to be the same no matter what. We're going to debit what it cost us to cost of goods sold, $300. And we're crediting merchandise inventory because when we sell inventory, it's going away. We sell it, it goes away. So we got to get rid of it. So these are our two journal entries here. Again, same thing for us. When we sell it to somebody, we're giving them a discount period. Boom, same exact stuff. Same exact stuff. We can offer them returns and allowances, as well as these discounts. So in this situation, on November 22nd, if our customer pays within the discount period, we're going to let them take the discount. We're only going to receive the amount of money that is the total cost minus the sales discount. All you're doing is taking that $1,000, multiplying it by either 2% to find out what the sales discount is, or multiplying it by 98% to find out what the cash we're bringing in is. Either way is fine. Either way is fine. And then you can just take the 1,000 and subtract out whichever one you did, and that will be the answer for the one you didn't do. If they pay after the discount period, it's a debit to cash, credit to accounts receivable. Now, again, we could have them where they refuse service or refuse some of the stuff we've sent them and send it back or whatever. We do that and allow our customers to do that because we want to make sure that we continue selling and having these people as customers. Because if we don't offer this, we're like, these people on eBay, oh, I don't take returns, forget it. Well, hey, that means the buyer is a lot more riskier for the buyer. And does the buyer want to take that risk on? A lot of places, a lot of people won't do that. They want to be able to return their stuff. And I agree. If I get something broken from you or something that you said was some way and it's not that way, I'm going to have a problem with that. In fact, I had that happen to me on eBay. I bought this game my children and I play, and they listed certain items in there as what they were. And there are variations of those items in this other kind of aspect game. And it ended up they gave me the ones that were this other variant, and it was going to cost me about another $100 to upgrade everything I needed to upgrade. So I pitched a fit to them. They gave me credit, but they weren't too happy. And I'm like, look, I don't know what to tell you, man. You totally botched this one. But so anyway, so we do that because we want to have a good reputation. We want people to buy from us. So when a customer returns merchandise, we have got to put it back into our inventory if it's not defective. If it's broken, if it's something else, we're going to scrap it. We're going to do something else. Don't worry about it too much. We'll probably value it at whatever cost we can get or sell it or do something. It'll be at a discounted price. We're going to value that at the lower of cost or market. In that case, it'd be market because probably if it's lower than our cost, then it's not worth it. So we're going to, if they return $15 of merchandise, we're gonna credit cash. Well, it shouldn't be cash actually. It should be accounts receivable. So that's wrong. This slide they messed it up. Cash should be accounts receivable there, and then we should debit sales, returns, and allowances. We don't debit sales. We debit sales, returns, and allowances. Okay, it's very important you do that. And then if the good's not defective, we put it back in our inventory. We debit merchandise inventory and credit cost of goods sold. So we send something, it's defective. They're like, yeah, we don't want it back. Then they keep it. We give them a $10 price reduction for it. So they're going to debit sales, returns, and allowances for 10. We're going to debit that. And credit, again, it should be accounts payable, not credit, not cash. Now, if we sold it to them in cash and they wanted to return it, then sure. But I don't know why they keep doing this cash thing. They keep screwing this up. But all right, so that's kind of the nitty gritty for your merchandising company. We do have adjusting journal entries and closing journal entries to do for merchandising company as well. You're going to find that they're very similar, very, very similar. Now, cost of goods sold is an income statement account, right? We're putting that on our income statement. That's important to know. So when we sell something, this is to record shrinkage. We're going to debit our cost of goods sold and credit our merchandise inventory. Shrinkage is people stole it, it got damaged, something happened to it. Whatever the case is, you are going to adjust it to cost of goods sold, even though you didn't sell it. It's just where we put it so that it gets expensed, because that's basically what we're doing with that. We're going to close our merchandising companies, and that was basically the adjusting entry. Sorry, for any shrinkage, in addition to any of the other accounts we've already talked about from the service companies, like accounts payable, depreciation, unearned revenues, stuff like that. All those could still apply to this company, but the main one that's going to be in addition to this is the shrinkage we're going to put in there. So then our closing entries are the same. We're going to debit sales and credit income summary. We're going to debit income summary and credit all the expenses, including sales and discounts, sales returns and allowances, cost of goods sold, depreciation expense. All these are going to be a credit. We're going to close it to the income statement, the income summary to the owner's capital account, and then close the withdrawals to the capital account. Okay, here's a summary of those purchases and sales. This is a good one. I would want to know this. I would have this handy. A lot of students get mixed up with the sales versus the purchases. You got to understand, are you the purchaser or are you the seller, and make the journal entries accordingly. So I would definitely take this slide, print it, copy it, put it somewhere. Definitely a good way to reference it. And then this is the continuation of that includes adjusting and closing entries. So again, another one I would definitely print off, have handy. So as we move into this, now let's go ahead and take a different step in this and talk about the multi-step or single-step income statements. That they're basically, I don't, they're going to tell you the same story. It's basically just how you structure them, okay? So here's your single step. You're very familiar with this. This is what we did in revenue side, okay? But then on the multi-step income statement, you're going to go through and you're going to kind of categorize stuff, similar to what we did with the classified balance sheet. We're going to categorize them in certain groups, like how we calculate gross profit. That's not anything earth-shattering, but we have operating expenses, we have selling and administrative, and then general selling expenses, general administrative expenses. Then we have other revenues and gains. Okay, don't worry about revenues or other gains and stuff like that. We're going to get into that more in accounting 112. But just know that these things exist. This multi-step income statement does exist. But it's just a way to break things down again. And then remember, in our classified balance sheet, merchandise inventory will be classified as a short-term or current asset. Okay, last thing on this video, we're going to calculate the acid test ratio and the gross margin ratio. They're really easy. The acid test ratio is very similar to the current asset or the current ratio. We're basically taking everything that is quickly convertible to cash and dividing it by our current liabilities. Acid test ratio, even though the current ratio tells you if your current assets can take care of your current liabilities, but if a lot of them are in inventory, if a lot of your current assets in inventory, then realistically, how are you able to spend or to pay off your current liabilities with your short-term assets? Well, if it's all inventory, unless you're going to discount it pretty heavily, you're probably not going to be able to use your inventory. So acid test ratio takes it one step further and essentially takes all your other current assets other than in inventory, maybe a couple other ones, and then dividing that by your current liabilities. Anything one or higher is that you're not going to have any liquidity issues in the near future, but it doesn't necessarily mean it's good, okay? You should have at least one. That's always a good positive thing. But if you end up with 3, 4, 5 as your ratio, that's too high, in my opinion. You just have way too much liquid assets. Do something with it. Short-term investments, turn them into long-term assets. Make more money on it. Usually the market will reward you for a longer-term investment than if you're just day trading. So that's kind of the concept here. Here's Nike's short-term, acid test ratio. You can see the difference. Look at the current year just alone. The acid test ratio is 1.1 and the current ratio is 2.1. That means they have as much in their inventory as they have in current liabilities. So you could arguably say that they have a lot of inventory, okay? And that's what I'm saying, like 2.1, hey, that sounds pretty healthy. But when you really, dig into the nitty gritty, you realize that really they're not as good as they. I mean, they're fine, but they're not as good as they, purport to be. And if you look over the 3 years showing, it's been in decline. Does that, and it doesn't look like that's in the inventory situation too, because it looks like their current assets have held pretty stable. I'm looking at their quick assets, and their quick assets have declined by almost $1,000. So, and that's probably in millions too. Yeah, millions. So it's actually $1 billion. Yeah. Oh no, we lost $1 billion. Whatever. Good for them. And then the gross margin ratio, you're taking net sales minus the cost of goods sold, dividing it by net sales. And that's just telling you basically how much you're making there to cover the profit. I'm sorry. I'll just read this. Percent of dollar sales available to cover expenses and provide a profit. So basically, for every sale here, you're going to take 44.7% of it in the current year. This is Nike again, I think, maybe. 44.7% of every sale is going to go to help cover expenses and provide a profit. So not too shabby, okay? I mean, the higher to 100% you can get, the better. But if you get to 100%, that means you're probably a service company because you don't have cost of goods sold. So, all right, that's the end of chapter 5. Your word today is SMART, SMART. Sierra, Mike, Alpha, Romeo, Tango for you military / law enforcement types. If you have any questions with any of this stuff, please let me know. Again, I cut out a lot of the end slides. There's a lot of little just chunky things that it wanted to talk about, how to do certain little obscure things, and I wasn't going to go into all that. It just gets too much. I think what I covered is more than adequate. But if you have any questions, as always, feel free to get a hold of me. Anyway, we'll see you guys in the next videos. Take care.